Liquidity strengths. What are liquidity strengths? Liquidity strengths are going to represent the strength of liquidity in a certain area. Liquidity lies everywhere, above and below every wick. But not every location has the same strength as others. Liquidity can be separated into three categories: minor, medium, and major. Why are liquidity strengths important? Liquidity strengths are important because it will give you a good idea of how far price may go if it is swept. Remember, the more liquidity there is in an area, the more orders there are. The more orders there are, the more orders banks can fill to flood the market in the direction they want. What this means is the banks are able to move price further relative to how many orders they are able to fill. The more orders they can fill, the further they can take price. The banks will not be able to move price as far as they want with a small amount of orders. With this understanding, you can begin to see the amount of liquidity that is needed to get to a certain area. There is no set of rules as to how much liquidity is needed to go to a designated area. This is all based on the algorithm and liquidity needed to get there. Although you will never know how much liquidity lies in an area or how much liquidity is needed to get to a certain spot, over time you will be able to get a general idea of what it will take to get to an area. For example, if the algorithm's objective on the daily time frame is to create a new structure higher high that is 200 pips away, it will need to take a large amount of liquidity to get there. This can be done by taking out major strength liquidity areas, several or take out a major strength liquidity area, several medium strength liquidity areas, or many minor liquidity areas. One way or another, a large amount of liquidity is needed to drive price 200 pips. Price cannot only sweep one minor strength liquidity area and take off 200 pips. I will break that down a little bit more if I need to after I break this down. How to spot liquidity strengths. The easiest way to spot the strength of liquidity is by the time frame you see it on. A minor liquidity will be represented on any time frame below the H1. Medium liquidity will be represented on any time frame above the H1 up to H4. Major liquidity will be represented on any time frame above H4. You can transfer this concept to any set of timeframes you would like to. For example, if you are an intraday trader and typically spend your time on the H1 and lower, then you may mark up the major strength liquidity areas as the H1. You then might consider the medium strength as the M15 timeframe and the minor strength as the M1. It can be translated into whichever style of trader you are. Another method you can use is to use a higher time frame range as the major liquidity. After that, find a range within the first range and label it as the medium. Finally, find a range within the second range and label it as minor liquidity. In other words, the smallest range will contain the minor liquidity, the largest range will consist of major liquidity, and the range in between will have the medium liquidity. Overall, you need to think of liquidity strengths in the form of how many other traders are seeing it. The more traders that see a distinct form of resistance or support will be enticed to enter the market, which in turn increases the amount of liquidity in that area. The more traders that do not see a distinct form of resistance or support will not be enticed to enter the market, which in turn decreases the amount of liquidity in the area. Typically, this has a strong correlation with major liquidity strengths on the higher time frames and minor liquidity on the lower time frames. So here are a couple of examples. I might bring up some charts too to help out a little bit more. But in these examples, what I'm trying to show you is this. So this is an example of using range within range. Meaning, right here, black represents the major. Why is this the major? Because it's going to be the largest range. From this high down to this low, these are going to be the major liquidity areas in terms of liquidity strength. From here, you can also see that there is internal structure. We have a range high, range low, range high, range low, range high, range low, up to a range high here. This can be referred to as medium strength because it's not as big of a range because it's within the major range we just plotted, but it's also not the minor just yet because as we continue to plot these, you can see from this low to this high, down to this low to this high, you have these smaller ranges. This is a smaller range relative to the range it is in. Therefore, in this example, I break down major being from here to here, medium being in between or one step lower from these highs and lows right here, and then minor being the ranges within those ranges from here to here, here to here. I bring this up, but before I do that, I will bring up another example and then I'll maybe break it down a little bit more to make it understandable and why it's important. Another example, we have the biggest range here, so that represents the major liquidity by black, and then you have the white, which represents medium. You have a range within the range, but then even within that range, you have another range or ranges, which are from here to here, which represent the minor liquidity. So here's a couple of examples. I won't break them all down, but you guys get the gist of it. Here's the main range, and then you have a range within it, and then even within that range, you got smaller ranges within it. Use the same exact concept. So in this case, I bring this up because in order for price to move, it needs the opposing order. Meaning if price wants to go up, the banks want to move price up, then they need to take out sell side liquidity. That might look like this. They need to take this out so they can fill their buy orders to move on up. They need to take out liquidity to go on up. The more liquidity they can take, the further price can go. Why can it go further? Because if the more liquidity that gets taken, the more buy contracts they can place in the market. And obviously, the more buy contracts you have, the further you can go, the harder you can push, the faster you can push. If you don't take out a lot of liquidity and you just kind of just take out one low like this, you're probably not going to do like this. You're not going to see the market do that. Why? Because this little bit of liquidity is not enough to just skyrocket to the moon. If price does this, you probably want to look back and then you'll start to see maybe something like this. And then you realize, oh, it actually took out all of these lows. So this right here wasn't the main liquidity sweep that caused price to move. It was actually this major area. And why is this a major area? It could be for several things. Simply put, it could be from a higher time frame low. It can be from a higher time frame range, or it could just simply be a very distinct level of support. Or in this case, if you want to use demand, which I haven't got into just yet, but for now, we'll use a level support, a very distinct level of support people will be looking to buy, and price sweeping underneath is sweeping out all of this liquidity here because everybody sees all the bounces from here. So obviously they expect price to bounce from here. They get swept out, and all of this is what fuels price to be able to skyrocket to the moon. I think a great example of this, like if I go to gold and I am on the weekly time frame, I'm looking at the weekly time frame, or even like the monthly time frame, you can see that this is a very distinct area. Why is it distinct? You can see the clear rejections, clear rejections, clear rejection. As of right now, you can see price got above and you see the wick that came in here. So here, there's a lot of fuel to push price on down here. Another example, you can see how there is a clear support level here. You can just draw a line if you want to. I just drew a zone. Clear line. When price gets underneath here, you can see the bullish volume come into play. This move cannot happen if it just takes out a 1 minute low. If you notice, this move took out a monthly low. It took out several monthly lows. You can see, even make it a little bit cleaner, you can see all of these lows from here getting swept, moving it outwards. This whole area gets swept. And this is what allows price to explode out of here, right? Price cannot move 1,700 pips by taking out a 1 minute wick. It moves 1,700 pips if that's how, I think that's what it is, 1,700 pips. It has to be 7, yeah. Like 1,700 pips when it takes out big areas of liquidity. And how do we know this is a big area of liquidity? One, because this is the monthly time frame. And also you can see how clear and distinct this is. Think of all the traders that were trying to buy off of here. If I go to replay, like this. They say, hey guys, look at this beautiful support zone. Look at this beautiful demand zone, whatever they want to call it. Let's buy from here. And when price ends up sweeping them out, you get the huge bullish candlestick. And that doesn't happen by just taking out a 1 minute low. That happens by taking out big, major strength liquidity areas, right? So that's what I mean by when you're looking at certain time frames, looking how distinct things are. That's how you can identify big areas of liquidity and identify strengths of liquidity. For example, I'm not going to anticipate this 15-minute low to get broken and then price to do this. That doesn't make any sense. Why? Because it doesn't take out major liquidity. It just took out this 15-minute low. If price is going to get there, then most likely what's going to happen, this low is not going to be enough strength for it to skyrocket to the moon. What's going to happen is price will come on up, take out liquidity from here, keep going up, take out more liquidity from here, keep going up, maybe take out all this liquidity, and then work its way up by building liquidity, sweeping it, and then working its way on up, which is more likely what you see the market doing. It builds liquidity, sweeps it, continues higher. Builds liquidity, sweeps it, goes, keeps on going higher until finally it gets up here. Price just taking out this 15-minute low is not going to be enough for price to just do that. It doesn't make any sense. Why? Based off liquidity, how orders get filled, and things like that we have gone over. So I bring up a couple examples how you can kind of use a range within a range within a range. You can plot your major, medium, and minor from that. You could utilize your minor only comes from below the H1, the medium comes from the H1 to H4, and major comes from the higher time frames. That is definitely possible as well. You can kind of mix and match whatever you want to do. But ultimately, the main concept I'm trying to teach you is if you take out a monthly resistance level, you can expect probably a big move to come out of that. Why? Because from my monthly time frame, there is a lot of liquidity coming from there. If price takes out a 5-minute low, do I expect price to move 100 pips in the opposite direction? No, that doesn't make any sense. It doesn't have enough fuel to go 100 pips, right? So if it is going to go 100 pips, it has to take out many 15-minute lows, has to take out many 5-minute lows, has to take out many medium strength liquidity areas, has to take out many, many, many minor strength liquidity areas. So hopefully that makes sense. Here are a couple examples of the charts. I pretty much just drew the range within range idea, and you can plot medium and minor strength liquidity areas. If you have been with me for a while, I don't mark my charts like this. I don't say, oh, this is minor, this is medium, this is major, and plot that way. But when I see price sweep liquidity, I have a good understanding. Okay, is this a big level? Is this a major strength level? Am I taking out a weekly zone that's super distinct and clear and everybody and their moms is seeing this? Or am I taking out a minute high that is very minute, which is going to be a minor sweep of liquidity? That's what I'm doing in my head. I'm not drawing it like this and drawing all these lines, but for educational purposes, yes, I'm doing this for you guys.